In this video, we're continuing discussion of Chapter 5 for Principles of Accounting 1. The first inventory costing method we're going to talk about is called Specific Identification Method. In Specific Identification Method, when we sell inventory, we calculate the cost of the actual items that are sold. So you see here these 8 items at $91 and 12 items at $106. So if we go back to that inventory record, you can see that we had 10 units at $91 and 15 units at $106. So we sold 8 of, in this 20 units sold, 8 of them were the $91 units and the remaining were the $106 units. Okay? And then on the August 30th sale, we sold 2 of the $91 units, 3 of the $106 units, 15 of the $115 units, and 3 of the $119 units. So that specific identification is that we use the specific dollar amount that correlates to our inventory sold. Specific identification is typically used for large cost expensive items, cars, jewelry, items with the unique identifiers and unique prices. Okay, first in, first out. Okay, in, first out, our oldest costs of inventory end up on our cost of goods sold, and the more recent costs end up on our inventory. So what that looks like is where we have this information here where we had 15, we had 10 in our beginning inventory. And then we bought 15 more. So now we own 25, 10 with a value of $91 and 15 with a value of 106. When we sell inventory then, we have to sell these 10 first. So the 10 at $91 that were in our beginning inventory are the first ones we're going to sell when we sell inventory. So in this sale on August 14th of 20 units, we're going to do the 10 at $91 first, and then the 10 at 106 second, leaving us 5 at $106. So if you remember with the specific identification, we sold 8 of the 91 and 12 of the 106. With first in, first out, you have to sell all 10 of the first ones, first in, first out, and then you can sell the next inventory that we have on hand. So then you see here, we buy an additional 20, then we have 5 at 106 and 20 at 115. So down here, when we sell 23 units, we need to get rid of the first in first, so that those 5 at 106, and then we can sell 18 of the ones at 115. Okay, so we're looking at this example here. So we have the following inventory information. We have a sales price of $40 per unit. So what we want to do is calculate the cost of goods sold and the gross margin using FIFO. Okay, so we have this information here, and I'm going to escape out again. So I can write on that. Okay, so we have 200 units at $10. So if we do 200 units at $10, I'm actually going to input a insert rate. Okay, so we have inventory value 10 times 200 of $2,000. Okay, we sell 150. That's 150 at $40, which equals $6,000. Okay, And now we have 50 units left. $50 times 10, which equals $500. Okay. We then purchase an additional 350 units at $15. So now we have 50 units. So we're doing FIFO. So we have 50 units at $10, which equals 500. And now I'm going to make this a little bit bigger. And then now we've also added 300 at $15, which is $4,500. We then sell 300 units. Because it's FIFO, of those 300 units, 50 of them, so we're going to do 50 of them at $10. So let's just do the sales price times 40. So 300 times 40 is 12,000. Okay. So now what we have left is we had to sell the 50 at $10 first. So we need another 250 to make this $300 sale. So we sold 250 of the 300. Now we have 50 left at $15, which is $750. Then we buy 450 at $20. So we have 50 at 15 or 750, and we have 450 at $20 for 9,000. Okay, lift this up so you can see. Okay, then we sell 430. So 430 times 40 equals 17,200. Okay, and after that sale, what we have left, we sell these 50 first, and then, so we don't have those 50 anymore. And then we sell 380, because 430 minus 50 is 380 of the $20 ones. So now we have 70 of the $20 left. And then we buy another 100 at $25. So now we have 70 at $20, 1,400. And we purchased 100 at $25 for $2,500. Okay. So now our total sales. So we wanted to figure out what the gross margin and the cost of goods sold are. So we have what our total sales. So 6,000 plus 12,000 plus 17,200. So our sales are $35,200. Okay. Let's curve below. So sales, $35,200. And then we'll look at our cost of goods sold. Okay, so our cost of goods sold, we had 150 that were of this 200. So we have 150 times $10 for the first sale. And then we had 300 for the second sale, and 50 of them were at $10. So 150 times $10 is 1,500. And then we're going to add this 500. Okay. And then we need to add that we sold 250 at 15. So we'll take add 250 times 15. Then the sale of 430, we need to add 50 at 15. So 50 times 15. And then we need to do 380 at 20. So plus 380 times 20. And we get cost of goods sold of $14,100. And the gross profit is sales minus cost of goods sold. So $21,100. Okay. Then we go to LIFO, which are the most recent costs go to cost of goods sold, and our oldest costs sit on our book and inventory. So we're going to look at the same exact example. So in this example, it just flips what FIFO does. So we're the same numbers, same stuff here. So we start with the beginning balance, 10 at $91, and then we buy 15 more at $106. So we have 10 at $91 and 15 at $106. With FIFO, with LIFO, it's the last amount in is the first out. So when we sell 20, we are going to move these 15 at 106 first, and then do what's left of the $91. Okay. Then we buy 20 more at 115 and 10 more at 119. Then when we sell 23 at the end of the month, we use the last cost first. Okay. This LIFO example, I'm actually going to skip. I have examples in the example video that you can look at for what LIFO looks like. Now, weighted average. So whenever a unit is purchased or sold, the average cost of each unit in inventory is assigned to the cost of goods sold. So every time we buy new inventory, what we do is we add the previous cost plus the new cost, take the average, and that's the cost we use. So let's look at this example. So we start with 10 at $91. And we buy the additional 15 for 106. So we add those two together, 1,590 plus 910, divide it by the 25 units we have, and now we have a new per unit of $100. Weighted average is actually the most accurate because you're averaging your cost of inventory across periods. Okay. So then we see what happens when we sell them. Then those 20 bikes, we use that $100 as the cost of goods sold. Okay. And then when we purchase more bikes, so we purchased the 20 additional bikes on August 17th for 115, then we add them to the 5 bikes that we had at 100. we have total inventory of 2,800. We divide that by our 25 bikes, and we get a new average unit of $112 per unit. So every time we make a purchase, we update our average inventory cost. Okay? And then our third purchase on October 28th, we would do that process again. Now we have 35 units in stock with a new average price of $114 per unit. Okay, and again, where I have an example of this on the Excel video. Okay. So what happens on our financial statements? Why do companies have different methods that they use? Okay, they have different reasons for this. So in companies that have a lot of volatile costs, um, they use a method that works better for fluctuating costs. It also affects how much a company pays in taxes. So we'll look at this. So ending inventory is the current cost of inventory. Okay. Um, so our ending inventory is the current cost of inventory, and what ends up in our cost of goods sold is old cost of inventory with the first in, first out. With the last in, first out, the cost of goods sold on our income statement is our most current cost of inventory, and older inventory costs are on our balance sheet. The weighted average method smooths out any price changes we have in our industry by averaging them out across all of our units. So we can see the different effects here of the cost of goods sold between specification method, FIFO, LIFO, and weighted average. Um, and because of that, there are different tax burdens. So companies that use LIFO for the tax benefit. That's the main positive of using LIFO is for that tax benefit. Then you can see the cost of our inventory on our balance sheet is different for each method. This is why when we're doing financial statement analysis of a company, you need to read in their financial statements and see what financial method they're using so you can understand the information behind their numbers. Because if they're using LIFO and you're trying to compare them with a company using FIFO, you're going to see that their costs are going to be different. Okay, and I know this video is getting longer than I like to get videos, but since I only have a couple of slides left, I'm just going to keep going and finishing them out. Okay, so tax effects of costing methods. Companies that want to use LIFO for tax reporting to get that cheaper tax available to them must also use it for financial reporting. So companies can't just choose to use LIFO for the tax benefits. They have to use it for both methods if they're going to use it at all. As I said, because IFRS does not allow for LIFO to be used, very few newer companies use this method. Okay. Actually, I am going to move this to another video.